As you know, we are now starting topic 6, which deals with payroll. Last week I gave you a little introduction to the topic and mentioned that we've been through the accounting cycle. You've had practice journalizing and then posting to a ledger. We've talked some about financial statements. Now the rest of the course actually will be taking a look at some parts of the business that are a little more in detail than you are used to. One of those areas is in the area of payroll. And what you see on your screen is an entry that we've had before in a couple of the problems. Uh, you had salaries expense, for example, and then you debited that amount. You see here a debit on November 9th, 2018, salary expense debited by 10,000, cash is credited by 10,000. That was the entry you had in a couple problems earlier. Now we're going to take a look at that and some other transactions later on that will be a little more complicated than this. As you saw in the videos from last week and then today, there are a number of what we call payroll deductions that the accountant has to consider. If you now have a job or you've had one in the past, and if you were paid by a paycheck, you may be somewhat familiar with some of those payroll deductions. A lot of these are required by law. The accountant and the business don't have a choice regarding some of these deductions. So they have to be done, and we'll explain why as we go through this entry. But what you see on the screen is a very simplified version that you've had before, as I said. Salaries expense would have been debited, cash credited, and then we moved on. But now we're going to look at the same entry for the Mid-Ohio Farmers Market and give it a bit more detail. First of all, let me get rid of part of this entry. We'll keep the salaries expense. We will assume that in this company we pay the employees every week. So November 9th is a Friday. We have our payroll entry, and the total amount earned by our employees is 10,000. At this point, this does not indicate to us how many employees there are, but we'll worry about that a bit later. But let's assume they earn a total of $10,000. Now we're going to look at some of the deductions that need to be made. The federal government requires that we take out federal income tax. Now, what this means is all employees have to pay tax to the federal government. But instead of waiting until the end of the year, the government wants the money paid periodically. They want the money a little bit earlier. So whenever we have a payroll, we have to take out some money from our employees, take it out of their paycheck. This is money that they've earned. They've earned $10,000. We will take some of that money out and put it aside into an account that we'll talk about in just a second. And later on, we will pay that money on behalf of the employees to the federal government. So the account is federal income tax payable. Now, there are a number of steps that need to be taken with each employee to determine how much money to take out of his or her paycheck. And we're not going to worry about those steps and those details right now, but let's just assume for our purposes right now that we take out an amount totaling $1,000 from our employees. Now, this is not just for one person, but this could be 5 or 10 or 15, but let's say it adds up to $1,000. What that means is that we will take that money out of the amount that they earned. We will hold it for them and later pay it to the federal government on their behalf. You'll notice the account we use is a liability account. The federal income tax payable is a liability account. And a little time out here to explain this. You've learned in the past that when you incur a liability, that you get an asset in return. This is the exception to that rule. It is generally accepted accounting practices that we use a liability account to keep track of this. So it's still listed under liabilities, just like accounts payable or loans payable or mortgage payable. This is a liability account, even though we do not, in this case, get an asset for it. So you just have to remember that this is treated like any liability account. So if it is credited, as it is here, it means the liability account increases. We owe more money. We owe the money because we took it from the employees, and we're going to have to pay it for them. So it becomes a bill that we have to pay. So we keep it in this account for the time being. There's also one called the state. Let's call it state income tax payable. And let's assume that we have an amount of money that we have deducted from our employees. Let's just say, for the sake of argument, it's $700. Again, there's a whole series of steps to determine how much money each employee has to be have taken out of his or her paycheck. But we're not going to deal with that right now. A little bit later we will. But right now, let's assume that adds up to $700. Again, it's a liability. We owe it. It increases. We keep it on behalf of the employees, and eventually we pay it to the state, in our case, to the state of Ohio. Another one that you've learned about is called FICA, Federal Insurance Contributions Act. As you know from your videos, FICA includes Social Security and it includes Medicare. Those are the two primary parts of FICA, the Federal Insurance Contributions Act. Again, these are federal programs. These are required by law. We have to take that out of the employee's paycheck. How we do that and how much is something that we will worry about a little later. But right now, let's say that it adds up to $1,530. So that, again, is a liability just like the other ones. And this is part of our payroll entry that we would have to do every single week if we pay these people every week. And finally, there's another income tax. City income tax payable. Now, whether this is your city or a different city, it might vary depending on where the employee works. Some cities have a city income tax, some do not. But let's just assume, for the sake of argument, this one does, and we have to withhold some money from our employees, and let's say it's $200. So again, these are all liability accounts, and we owe money on behalf of the employees to the federal or the state or the local governments. And finally, the last part of this entry is cash. And remember, we started with salary expense being debited by $10,000, cash being credited by $10,000. It's not going to be $10,000 credit to cash now. It's going to be the total of these numbers. We add these up and subtract it from 10,000. If you do that, I believe you'll come up with 6570. And this is what we call the net pay. This is what we're actually paying out right now on November the 9th for the weekly payroll. Our employees will get a total of $6,570. We don't pay them $10,000. We withheld part of the money. This amount of money, when you add up all those numbers, represent the money we have withheld from the employees. So eventually we will pay it because they are considered liabilities. Like any other liability, it's something that we owe, even though in this case we don't get an asset in return, but we owe it on behalf of the employees, and we will have to pay it. Typically, these kinds of things, federal income tax payable, state, FICA, city income tax, are paid quarterly, like every 3 months, sometimes every 6 months, but typically they're paid periodically on behalf of the employees, so we have to keep that money aside in a liability account. But we are paying the employees their net pay, which is $65.70. So this now becomes the payroll entry. There are other types of deductions. We could have more things on the credit side before we get to cash. For example, sometimes a company will have fringe benefits that they offer to employees. so that they attract more people to work at that particular company. For example, some companies will pay part of your health insurance if you're an employee there. So they may say, if you come to work for Mid-Ohio Farmers Market, we will pay 20%, 30% perhaps of your health insurance, and you pay the rest. So that's a benefit. Instead of paying the whole amount of money for your health insurance, you'll pay just part of it because the employer will pay the other part. So that becomes a problem also for the accountant to keep track of all that. That becomes another payroll deduction, and that becomes even more complicated, as we will see. That's why the bigger the business, the more accounting staff is needed. At this time, go back to your course page. There are a couple questions I want you to answer.